Hello, everybody. Apologies, my I was recording and I was on mute, so I've had to re-record this. All right, so it's the 17th of Feb, and now this is an Asia session trade based on the two-step model that I use every day. So the two-step model can be used in a micro session. So, for example, New York AM session, or it can be used across session. So you can measure Asia v London or London v New York, etc. You can also use it across higher time frames, so 4 hours, daily, etc. Now, the two-step model only has three steps. The first thing we have to establish is just a direction based off an anchor. In this case, I'm anchoring off the 5 a.m. This is a nice, clean anchor on ES. So I'm on the ES. This is the 50 minutes, so let me go back to the 5 minutes. And so 5 a.m. is a good anchor, 9:30 is a good anchor. Those two are good. 6 p.m. also very good anchor. So when I see direction from that anchoring, I take notice of it. Now, I'm about to explain something that sounds complicated, but is really simple. I am watching the 5 minutes, which is my operational time frame, in relation to the 30 minutes, which is technically the higher time frame to the 5 minutes. What I'm watching is trend alignment, right? So in this example, 5 minutes is fully bearish. So we're talking 25 plus bars, all red. But the 30 minutes is bullish. Now, what that means is one of two things will happen. Either the 5 minutes will drag the 30 minutes bearish, or the 5 minutes will bounce off the 30 minutes and go and align back bullish with the 30 minutes. So that's your 50-50 choice right there. Now, how do you stack the odds in your favor? Well, if you follow the two-step model, step two is in that directional move, find the 5 minute fair value gap. It has to be 5 minutes in my case. I don't use any other fair value gap. Yes, it may work, well, it will work. I just record it. I don't actually trade it. I only use 5 minutes. Even on higher time frames, I will only use 5 minutes. So step two is you're watching the retracement of price into that 5 minute fair value gap. And that 5 minute fair value gap must overlap. So if you take this high and this low, that overlaps with what? The 60 fib. So you have confluence, right? So now you have the three parts to your model: direction, fair value gap, and a confluence, which is fib, fair value gap, and price. Everything else from this point is experience, because at this point we are looking for entry, stop loss, targeting. You're targeting, take the fib, place it at the highest point of the retracement, wherever that is. Doesn't have to be accurate, and it gives you an idea of where your targeting is, because it's 100% of the directional move. So it's a measured move. So you have your targeting. Your entry is simply you're waiting for a rejection. And once you have that rejection, your stop loss is just based on your risk. You can put it above the rejection. You can put it above the candle that creates the fair value gap. You can even put it across the swing. It all depends on your own personal risk. So every trade for me is very different. So I'm generally risking between $500 and $2,000 per trade. It just depends on the trade. In this example, because it's cross session, I am watching the 1 minute, 5 minute, and 15 minute. So on the 50 minute, I'm on the 50 minute right now. You can see it's classic rejection. This is classic. This is not market structure shift. This is not, an inside bar, blah. Like this is just a classic rejection. Price goes up, taps something, rejects, goes down. So it's an up thrust. And in VSA we call it an up thrust, right? Very, very classic. At this point, all you're looking for is any price movement back into that up thrust, so into that wick of that up thrust, and then you're taking your trade. Stop loss above that up thrust or above your fair value gap bar, okay? And that's it. Just wait for price to do its thing. As you can see, it hit my target. So this is in Asia. This is a cross session trade. When I see this, it's usually because I'm monitoring price from the previous day. So for example, because price did not activate either at the AM session or the PM session, that's usually when you have these cross session opportunities, because all you have is just AM running one way, PM is basically doing nothing, and then you get the retracement either in the PM or early Asia into your fair value gap. That's the opportunity. Okay, it's a 50-50 opportunity because at this point, remember, the choice is the 5 minute is going to either pull the 30 minutes or it's going to bounce off the 30 minutes. Right? That's it. You're not going to win every single trade. So hopefully this is insightful. Actually, one thing before I actually end this video, what I'm going to do is I'm going to just add a just a SMA just to explain what I'm talking about here more visually. So you can use a normal SMA, right, to look at the trend. Now, if I go back to the 5 minutes, you can see that the 5 minutes from this 5 a.m. trigger was bearish, right? You can see what the line is doing. What I'm going to do, okay, is just put a line here as well. Let's make this a solid line. Now, if I go to 30 minutes, okay, let's go to the 30 minutes, right? The 30 minutes was bullish, right? It's very, very bullish. But there was a misalignment with price. So price was running down, but the trend was bullish. This is where the opportunities happen. This is where you start to think, okay, something's not quite right. It needs to realign. It's like a rubber band. A rubber band goes too far, it just needs to kind of realign. So this move going up is the 5 minutes. The 5 minutes is either going to realign with the 30 minutes or it's going to pull 30 minutes. As you can see on the 30 minutes, it was pulling the 30 minutes. That's the opportunity. So because you know the 5 minutes is pulling the 30 minutes, now you have more confidence when this 5 minutes started to trend up. So now 5 minutes is trending up. Okay. But you know it's a retracement into the fair value gap. Not if it goes past the fair value gap, you don't have a trade. But it didn't. That's it. This is the opportunity. When you find this misalignments between trend and price, and you just kind of add that with confluence, fib, fair value gaps. It sounds complicated to say, but the two-step model actually um, helps you codify it, right? It gives you a method to understand the madness. All right, guys. So hopefully you got something out of this video. I will see you in the next video.